Brian, thanks so much for joining us. And based upon recent volatility and some downturns in the market, how should we be adjusting our portfolios, or how should we be setting up our portfolios in this kind of market?
No, that's a great question. And of course, it all begins before the market falls. Once something's happened, it's too late. And I'm big on learning the wisdom of the ages. And so I fall back on that famous philosopher, Mike Tyson. And Mike Tyson said that everybody has a plan till they get punched in the mouth. And he was referring to boxing, but I think it's the same thing in the financial markets. Markets go up most of the time, but they do fall, and they fall sharply, as we've seen. And you need to be prepared ahead of time with a plan. And that plan should involve some sort of honest assessment of how much risk you can take in your portfolio.
Well, I think that's right, because we know the market's going to decline. It's just a matter, are you prepared for it?
Yeah, markets go up and they need to go down, and people forget about that. We had a pretty good run for about 10 years, and I think a lot of people got overly aggressive. They got excited about the prospect of making more and more money. We saw quite a rally last summer, and then it came to a screeching halt.
So we all would like to control the stock market, but we cannot. But what can we control?
Well, again, you can start with the level of risk that you're taking in the portfolio and make sure that that's appropriate. And then things like your bailiwick, which is taxes, right? A falling market isn't fun, but it does present the opportunity to maybe do some tax loss harvesting. That's something that can be controlled. Rebalancing to make sure that the risk profile is appropriate can be controlled. And then most importantly, make sure you're an investor, not a trader. And a lot of people confuse those two. I think, to be honest, in my opinion, that's the biggest mistake people make, is that they think that they're investing and they're actually trading.
And so what does that mean, to be an investor versus a trader?
So to me, traders get out there and they compete with professionals. And by professionals, I mean hedge funds, people with PhDs from MIT and Stanford, and reams of computers and fiber optic cables to speed their orders to the exchange floor. And then an average individual sitting at home in front of their computer tries to compete with them by speculating on what's going to happen in the short term, which is really just the theory of what is somebody willing to pay for something tomorrow. As opposed to investing. Investing is relying on the long-term upward progress of the economy, the fact that over time corporations generate profits and that those profits translate into higher stock prices. When you do that, you're not competing with anybody. You're just participating in the forward progress of humanity.
Well said. Now, our tendency, of course, in these kind of markets is to want to become more conservative. Markets go down a bit, it's like, ooh, I can't afford to lose any more money. Is that, and that's what our emotions tell us to do, but is that really the best course of action?
Well, it is perfectly natural to feel that way. It can be frightening. I mean, when you watch your wealth start to disintegrate, it's scary. And so it's important, again, to check back on why you own these things. And most of the time, it turns out that you own stocks or whatever's falling a lot for the long run. Even if you're already retired, you probably expect to live another couple of decades. You may not need the money from your stocks for 10 years or more, right? So a lot of times, and it sounds counterintuitive, the best thing to do is actually to buy more stocks. That's that rebalancing process where if stocks have fallen sharply, you sell some of the bonds or whatever you have in your portfolio that's done a little bit better, and you replace it with some more stocks. Again, buying low, selling high.
That's hard to do, though. Buying when the market crashes or goes down, it takes a disciplined plan.
Oh, absolutely, and it's contrary to human nature. In a lot of ways, our human brains are our worst enemies as investors. And I think that's one of the benefits of writing something down on paper. And that could be a really robust financial plan, or it could be the back of a napkin. But if you have something that you can refer to in writing, it makes it a little bit easier to fight your emotions and stick with what's actually going to work for you in the long run. And the other part is, turn off CNBC or the Wall Street Journal or whatever source of news you get, because they're being paid to attract eyeballs, and they're going to flash up every bad news headline. And there's a lot of studies that show that viewership of those kinds of things goes up tremendously when markets fall. And of course you're going to be nervous. You're already nervous because your portfolio fell, and now you're being bombarded with negative headlines, and it just becomes self-reinforcing.
So don't succumb to the noise and have a great plan. Try to stick with it. Brian, great information.